If you've been feeling like the AI trade is getting a little too crowded, you are not imagining it. The winners are still winning, sure, but the real question now is what happens when everybody piles into the same names, the same momentum, the same story? Because right now, some of the most interesting opportunities may not be the obvious AI darlings. They may be the trades that got left behind. And that is where things can get really interesting over the next 6 months. Hey, I'm Vanessa, and I break down the market moves that actually matter for your money. Today we're talking about 3 stories that all point to the same big theme. The AI boom is no longer just about the obvious winners. It's about what gets overheated, what gets ignored, and what could quietly catch up next. And one of these stories has a very real don't miss this angle, if you care about where your portfolio might have to flex next. Let's start with the big idea. ETF Action's Mike Akins is basically saying investors should look harder at the groups that have underperformed compared with the major AI stocks. In plain English, if everyone has been glued to the Mag 7 and the hottest software names, there may be a window opening in the parts of the market that got absolutely no love while AI was stealing the spotlight. That matters because markets do this weird little dance all the time. The crowded trade gets expensive, expectations get high, and then the stuff nobody wanted starts looking cheap enough to matter. Now, why should you care if you're not actively trading every sector rotation? Because when the market starts broadening out, it changes the whole tone. Yields can move, stocks can rotate, and AI expectations can get reset. That's a big deal. If the market starts believing AI is still powerful but no longer the only game in town, money can flow into the second layer of beneficiaries. Not just the headline names, but the suppliers, the infrastructure plays, the software laggards, the utility-like cash generators, the businesses that got ignored because they weren't flashy enough.
And that's the part I want you to sit with for a second. The best trade is not always the loudest trade. Sometimes the best trade is the one that spent 6 months getting punished while the popular names got bid into the stratosphere. That's exactly why people like Akins are telling investors to boost exposure to underperforming groups. The setup isn't AI is dead. Not even close. The setup is AI is huge, but the easy money may have already been made in the obvious names. Different thing. Very different risk-reward. So how do you think about that as an investor? Ask yourself one simple question. If AI keeps growing, who benefits after the first wave? That's where the opportunity lives. And if you're too concentrated in the same mega cap names everyone else owns, you may be taking on more downside than you realize if expectations cool even a little. Crowded trades don't usually break because the story disappears. They break because the story gets too well owned. Now, let's talk about a name that sits right in the middle of the AI conversation, Datadog. On the surface, this is one of those stocks people want to love. It's a serious cloud observability platform. It has been improving its business with AI, and its Q1 revenue acceleration was meaningful. That sounds great, right? It is great, but the market is not paying you for great. The market pays you for great plus a price that still makes sense. And right now, the argument is that Datadog stock is too risky. Why? Because when a stock already has a lot of AI enthusiasm baked in, even strong progress can disappoint if the bar is sky high. That is the game. The company can execute, revenue can accelerate, the product story can improve, and the stock can still wobble if investors were expecting perfection. That's why this matters to you. AI investing is not just about finding good businesses. It's about not overpaying for the growth narrative. If you're holding a stock like Datadog, the question isn't just, is the company improving? It's, is the improvement already priced in? That's where people get burned. They buy the future, but they pay for a future that has already been imagined by half the market. Then the stock has to do something extraordinary just to keep up. That is not a comfortable place to be. And there's another wrinkle here. AI is changing software, yes, but it is also raising the standards. Investors now expect faster growth, better margins, and a cleaner path to monetization. If a company says AI is helping, but the valuation is still rich, the market can get impatient fast. So Datadog becomes a perfect example of the broader theme today. Not every AI-linked stock deserves a premium just because it says AI a lot. The business still has to earn it. Okay, Now let's pivot to the story that feels a little different, but is actually connected in a really important way. NuScale Power, ticker SMR, trading under $10. Bargain buy or value trap? That's the question. And honestly, that question is exactly why this stock is so interesting. The big thesis is simple. AI has an insatiable appetite for power. Not metaphorically, literally. Data centers need electricity, and a lot of it. That is putting nuclear energy back into the conversation. And companies like NuScale are getting attention because they represent a possible long-term solution for the power demand coming from AI infrastructure. If AI keeps scaling, the energy side of the story gets more valuable. And if the energy side gets more valuable, then the market starts asking whether these beaten-down names are secretly sitting on a huge opportunity. But let's not get carried away. A stock trading under $10 can be tempting for all the wrong reasons. People see a low share price and think cheap. Not always. Sometimes low-priced stocks are low for a reason. That's why SMR is such a classic fork in the road. Is the market underestimating a future power solution, or is it pricing in the real execution risk?
Because nuclear is not a quick flip. It's capital-intensive, highly regulated, and full of long timelines. The upside can be massive if the thesis plays out. The downside can be brutal if the timeline stretches or demand doesn't materialize the way bulls expect. Still, I get why investors are looking at this space. AI is not only a software story anymore. It's an electricity story. It's a grid story. It's a capacity story. And when you connect those dots, companies tied to power generation suddenly look much more relevant than they did a year ago. That's why this is not just some random speculative stock pitch. It's a bet on the backbone of the AI economy. And those are the kinds of bets that can matter for a long time if you get them right. Here's the tension, though. When a theme gets hot, investors tend to chase the most obvious beneficiaries first. That happened with chips, then with big cloud names, then with software. Now the conversation is moving into infrastructure, power, and the less glamorous parts of the stack. That's where the next wave of returns can come from, but it's also where the risk gets easier to miss because the story sounds so compelling. AI needs power is true. The harder question is which companies can actually turn that truth into durable shareholder value. So if we zoom out, all three of these stories are basically telling you the same thing in different ways. First, the AI trade may be crowded enough that the next move is rotation, not just continuation. Second, even strong AI-related businesses like Datadog can still be risky if the market has already priced in a lot of good news. And third, the energy side of AI may be one of the most underappreciated opportunities, but it comes with real execution risk, especially in a name like SMR that can look cheap for reasons that are not exactly friendly. That's the part most investors skip. They want the headline without the homework. They want the next big thing without the patience. But if you're trying to actually grow money in a market like this, you have to think in layers. What's crowded? What's overlooked? What's already expensive? What still has room to surprise? That's where the edge comes from. And let me give you a practical takeaway here. If you're heavy in AI winners already, don't just ask whether you like the story. Ask whether your portfolio is too dependent on the same handful of names doing all the work. If the market broadens out, you want to have some exposure to the laggards that can catch a bid. If you're looking at AI-linked software, separate the businesses with durable acceleration from the ones that are mostly trading on enthusiasm. And if you're tempted by nuclear or power plays, make sure you understand the timeline, the financing needs, and the volatility before you treat a low share price like a discount rack. Because that's the trap in a market like this. The obvious trade feels safe because everybody knows it. The overlooked trade feels exciting because nobody owns it. But the real money is usually made by understanding which one has already been run too far and which one is just starting to get noticed. So yes, AI is still the engine. But the next 6 months may not be about chasing the same engine parts everyone else already bought. It may be about the underperformers, the infrastructure, the power plays, and the stocks that look a little boring until they suddenly don't. And that, honestly, is where the smartest money starts to get a little flirty with the market again.